The back end just flagged the 30-year Treasury at 5.13%. A second straight push, now 5 basis points from the May ceiling that broke this market. The scan still surfaced a #1 ranked stock and ETF in this environment. That reveals still ahead. QQQ staged a relief session today. But Nasdaq has been printing lower highs on the daily chart, with its moving averages in a bearish configuration. And the S&P joined with its own bearish reversal conditions. The VIX climbed above 20 during this stretch, which doesn't align with a clean bullish continuation. The 7427 level on the S&P is the system's near-term confirmation gate, and the macro data the system's been ingesting is exactly what's feeding that bearish skew. DXY is holding above key support, and the 10-year Treasury is sitting above the threshold the system's flagged as a macro stress line. TLT is testing a structural floor right here. The standout on the readout is the 30-year, 5.13%, knocking on the May ceiling at 5.18, the level that broke this market 2 months ago. If that resistance zone holds, it's noise. If it breaks higher, the entire dollar in rates picture shifts. And that's exactly the chain that fed into energy prices today. WTI closed below the 8750 resistance zone. XLE caught a bid on Hormuz and Red Sea disruption signals, second only to tech on the sector board. The system flagged tankers carrying Saudi crude being forced to turn back in the Red Sea last week. And the Hormuz choke point carries roughly a quarter of the world's seaborne oil. There's a ceasefire mediation in play, which puts the energy read in two-sided territory right here. But that supply chain stress is keeping crude's bid intact. And that kind of hard asset inflation pressure is exactly what lit up the metals picture next. Gold is pressing into a key resistance ceiling. GLD is testing the zone it's been approaching for several sessions. Silver, via SLV, is advancing sharply, and copper miners through COPX posted a 6% gain today. Central bank accumulation and AI infrastructure demand are sustaining a broad bid across metals. The question the system flagged: is this real international demand driving the move, or purely a domestic inflation hedge? That answer came through clearly in what international markets did. Japan's markets, via EWJ, popped 2.6%. Semiconductor cycle demand is driving the move. Taiwan, through EWT, is riding that same chip wave, with the international read notching a real rebound today. The dollar's footprint is still visible here. DXY, holding up, is capping EFA near its 52-week high, which means the Asian gains are happening despite that ceiling, not because the dollar eased. That same dollar versus risk appetite tension carried straight through to what speculative assets did next. Bitcoin came in just under 67,000 today, right at a Fibonacci retracement that's also a horizontal resistance cluster. Over 5 straight days, spot ETF inflows into products like IBIT ran over $700 million. That's a real demand streak. But here's the divergence the scan picked up. The technical read frames this as a wave 2 counter-trend bounce inside a confirmed bear market downtrend, not a new trend. The flow data says demand. The chart structure says this bounce has a ceiling. When you've got that kind of split across asset classes, the best of best scan is where the system finds what's actually holding up. We opened on the 30-year at 5.13%. That's the macro weight pressing on every asset class we just covered. And the #1 ranked stock is still ahead. Here's what the best of best surfaced. 122 symbols from the full universe, filtered down to the setups where structure is aligning right now. Financials landed at the top of the sector board. Real estate landed at the bottom. That contrast tells you exactly where the scan is finding relative strength. And the top ETF and top stock are up next. The sector board from today's scan. Financials through XLF ranked #1, leading state. Healthcare through XLV ranked #2, also leading. Real estate through XLRE rounds out the top 3, but it's in a lagging state. The rotation read is clear. Strength in financials and healthcare, drag in rate-sensitive real estate. The #1 ETF and #1 stock are both coming out of this sector picture. Next, the #1 ranked ETF in the best of best right now is CRAK, the Van Eck Oil Refiners ETF, up about 1.61% today. CRAK sits at the intersection of the energy disruption trade and the inflation story we've been tracking all session. Hormuz risk, Red Sea supply chain stress, elevated yields. The scan surfaced it at the top position because the structural setup across energy is pointing in the same direction. And that's where the refining play is showing up in the rankings. And the #1 ranked stock in the best of best is WST, West Pharmaceutical Services, drug delivery and containment systems, a healthcare-adjacent name that gained nearly 2% on the session. WST ranked at the top of the individual equity scan, while healthcare holds the number 2 sector position. That's the system surfacing healthcare equipment as the top individual setup in this environment. The reveal the scan's been building toward all session. The 30-year at 5.13 turned out to be the thread connecting everything today. Elevated yields keeping the dollar bid, dollar strength capping international gains, energy disruption feeding inflation, and the scan surfacing a refiner ETF and healthcare equipment name at the top of the rankings. The thing to watch for tomorrow: does the 30-year hold that resistance zone and fade, or push through it? Because if it breaks higher, the headwind on rate-sensitive assets escalates sharply across the board. Verify both live in SignalFinder Pro. And remember, this is educational, not financial advice. Do your own homework.